Also friends, a couple of friends came there as well.
Nice.
All right, I'm going to show the screen straight away. Let's share the screen. Also friends, a couple of friends came there as well. Second.
Nice.
Okay, can you see the screen?
Yes.
All right, so I had some thoughts before I put this company for this masterclass, because it's very kind of interesting situation, that the market is falling down, and
very interesting.
Yeah, kind of, and it's very difficult to find a company which has more potential and less risks. Because at the moment, first of all, based on what happened in Europe, okay, the conflict between Russia, Ukraine, and Europe in general, and all the sanctions, they affected in a big thing. Okay, just a second. It seems like Jeremy cannot get in. Yes, Jeremy. Do you have a password there or something like that, maybe to get it? Because just a second, I'll try maybe. Okay, I'll see what I can do now. So okay, just give me a second. Okay, Jeremy. Nona, can you maybe send the Jeremy in our chat the link to get in, because it seems like he cannot get in.
I'm not sure how to do it, Igor, actually. I'm not that computer savvy.
Maybe. So straight, the rest of you joined, all right. Place meeting, strange. And just try to maybe to share it.
But it asked me to log in twice today, so I don't know. Maybe it's the same with, yeah. Once I logged on in our the Academy page, and the second time it's asking a Zoom for the same details.
Interesting. Okay, maybe. Okay, so let him try to figure it out, because same. Okay, can you maybe type it to Jeremy in our chat in Facebook, that it will help him to log in, because I'm out of Facebook right now, so I cannot text there. Maybe to give him this direct link, and he watched the stream on Facebook, on YouTube, but it will be able to only watch it, not comment or anything. Oh, actually, I'm in Facebook. Wait a second. Strange. Okay. Okay, we'll see if it helps him. All right, so I'm just wondering, can you see the slides? So
yes.
Okay, perfect. Now, so the main reason why I chose this company, because if you take into consideration all aspects which are happening right now, and especially like that the geopolitical tension between US now with China as well, like it continues from already. Trump started it as a tariff war, and Biden last week announced that if China is going to enter Taiwan, he's going to provide the military assistance to Taiwan. So it will create a huge conflict between two superpowers as well. And when you think about it, you kind of start be careful about investing, first of all, in Chinese companies, but secondly, in companies which have manufacturing facilities in Taiwan. And it's a lot of companies, IT infrastructure, American companies, which have presence there. And that's why when I was choosing some of the IT companies, they're in a very good position to buy them, fundamentally. But if we take this geopolitical risk, of course, it might never happen, okay? And but at the same time, I never thought that Russia will start war with Ukraine. So kind of you never know what is going to happen. So we have to consider this risk. So that's why I look at the company which going to be affected least if something like that take place. All right, and I look at the company which called Green. We analyzed this company in 2017, so it's already 5 years ago. And since that company moved up, and now it's down again. And I believe it represents a good opportunity, not right now, but maybe even now. But if the market continues to slide down, we even can get it at a better price. Now, interesting enough that the company changed its industry. It used to be pharmacy services. Now it's retail store. In the future, I'm probably going to put my comments why I believe that Value Line changed the name of the industry. All right. So, but before we go for what is happening right now with the indexes, you can see they're sliding down, and we already have 3 rolls, 1, 2, 3. So this is like that. So after third roll, the duration might be changed, but not always. And we might see fourth and fifth roll as well on a downturn. And if we go lower than this level, so the next level would be 29,300. So it's from 32,000, it's nearly 10% drop more. But before that, we could go up as well, so following the trend, okay, something like that. Interesting enough, if you look at this particular trend, you can see that sometimes we go all the way up from support to resistance, but sometimes we go only halfway. Like here, we went up on the halfway and dropped down. So a similar story here, we went up on the halfway, dropped down. So it's quite possible if we go only in a more narrow trend level. So kind of be aware of that. So even now we see a very nice candle from last trading session, and it looks like we're going to go up based on that. But it is quite possible that we move exactly the same direction, maybe 3-4% here, and then we might turn around and drop down again. So I actually didn't look at the market, what's happening today. So, but in Europe, I think it was a bit down. So I'm just trying to open it. So let's see what is happening. Okay, pre-market is down. And it's quite a lot down already. So we might see it turning back down here. So this is the situation right now on the Dow Jones. Even though we see that the indicators are in an oversold situation, but at the moment the first of all earnings still in place, and secondly the geopolitical situation was happening, so it might affect it. Move down. So Standard & Poor's looks very, very similar to Dow Jones, very, very similar situation. So, and exactly maybe roles are not as clear as with the Dow Jones, but exactly the same nice candle, green candle, but tonight it seems like it's going to go down again. Nasdaq, also we have one full roll, half roll, and a full roll. Again, with Nasdaq is a bit overvalued compared to previous two indexes. It's a bit more expensive based on P/E ratio. And like if we know the companies are included there, so they're tech companies, and usually like they are more pricey than other companies. All right, this is Nasdaq, and this is volatility index. Volatility index is at the moment at $28 level, and last year it was bouncing around 912 level. We can see that here it's already become like around 15, and now it's slowly moving up. So the index goes down, like Dow Jones, S&P 500, and Nasdaq, they're going down, and volatility index going up. So at the moment it's like a neutral situation. So it could go both way, up or down. All right. It seems like if the index is going down today, so we'll see that volatility index going up at the moment. So this is the P/E ratio. If you remember last month we looked, Dow Jones I think was around 20, if I remember correctly, at least more than 18, 19 or something like that, 20. Last year it was 29. At the moment is 18. So actually, if you go in history and trying to see what kind of P/E ratio in average, it's usually between like 15 and 18. Sometimes during crisis, it can go to like 8 or like 12 or something like that. During good time, like good time from P/E ratio perspective, it was nearly 40 for the last couple of years, right? So it was very, very high. So, but in average, it's between 15 and 18, and at the moment it's 18. So as we get to this level of average, it's still not low, but compared to what it was last year, it's definitely low. Now, if we go for Nasdaq is P/E ratio 25. Last year it was 35, and Standard & Poor 20. And not 37. So even if we go here, so it means that people now paying 30% less than last year for the same dollar profit. So last year they paid $29 for $1 profit, now $18 for $1 profit. And here the similar situation. So S&P 500 dropped from 37 to 20. So it's nearly half of that. Of course, even if you, like, for example, imagine that the company is making, and all companies included in this index making exactly the same money as last year, not increase, not decrease, but exactly the same amount of money. So it means that the index has to drop, in this case, 30%, in this case, like more than half, like nearly half. Okay, so drop around 40%. So here, 20, so it's what about 30% as well drop, so maybe a bit less. So that's how important to look not only at what happening with the price, but what actually happening fundamentally, because like the price of indexes cannot drop all the time lower and lower and lower unless the profitability of those companies also deteriorates. If the profitability of the companies remain the same or keep growing, so the price fall never, it cannot happen forever, right? So, and we spoke about it last year and previous year when P/E ratio was 40, we were talking about it that it's too high. Okay, it's very, very pricey, and we could expect a drop. So whatever is happening for the last few months, it's completely normal. I mean, from that point of view. Okay, this is the indexes. So if you have any question, please ask. Okay, Jeremy, nice to see you, and Dory, nice to see you again, Alex as well. So I can see you all guys got in successfully eventually. All right, Dory, by the way, are you back from your trip? All right, okay, so enjoying the lovely Sydney weather right now. Okay, now let's talk about the retail store industry, the industry which I want to cover. And the interesting enough that last time it was pharmacy services industry. I personally believe the main reason why Value Line changed it, because if you go to pharmacy services, like, I mean, whatever business they run, it's like stores. It's first of all, and secondly, they sell a lot of products similar to what, let's say, Walmart sells. So the structure of the business is very, very similar, but there are certain differences as well in this particular case. For example, if we go for bigger retailers like Walmart, Target, and let's say other Costco, right? So what they do, they sell a huge variety of products, and majority of them not licensed. Like if you don't take into account alcohol or some kind of cigarettes, where pharmaceutical services, they sell prescribed drugs, but on the top of that they sell all these cosmetics, perfume, personal products for hair, like skin, etc., etc. So a lot of similar products you can buy in Costco or in Walmart and in pharmaceutical pharmacies as well. So that's why probably Value Line put them in the same category. But still, when we analyze them, we have to look at them a bit differently, okay? Because they have still a bit different type of business. For example, personally, I believe that all these companies with food services, people, it doesn't really matter what is going to happen. Political situation, economical situation, inflation, but they're still going to go and buy food, all right? So it doesn't really matter the price for the milk. You still have to drink milk if you buy milk on a regular basis. You still have to buy bread, potato, etc., right? And probably this is the kind of more stable business model at the current time. Yes, profitability can shrink like it's happening right now, but from sustainability point of view, those businesses, they're going to survive unless they have high level of debt and they won't be able to manage, for example, their profit ratios, okay, different profit ratios. Now, if we look at pharmacy services companies, that sector within this industry, we might find different companies. Some of them they retail, some of them wholesale. Some of them sell online, some of them sell offline, some of them both. Okay, so there are different companies now. And also, it's very important to understand that if we compare with the just normal retail shops, which if I decide to open the retail shop tomorrow, I can do it very easily. I just need to rent a place and open the retail store. But if I want to open the pharmacy, it wouldn't be that easy, because in some countries there is a legal restrictions about how many pharmacies you can open in a certain population like level. For example, in Australia we have that, and you can open the pharmacy, but you wouldn't be able to kind of sell prescribed drugs using Medicare, right? So you would have to charge people, and of course you won't be able to do that, because if people get used to come and use Medicare and get practically drugs for nothing, they're not going to pay full price for that. So it's huge restrictions, and of course pharmacy businesses, when they're trying to expand, they cannot expand just by opening new locations. The way they expand is by buying existing pharmacies. For example, if there is let's say John Smith, right, and he's 65 years of age, and he's running his own pharmacy for the last 40 years, and he cannot pass it to his family, because if his son or daughter, they don't have pharmaceutical education, they won't be able to run this pharmacy, because you have to have this specific education in order to run the pharmacy. So it means that they have to sell it. That's all closed. This is the only choice for them to have. And what they do, they put it on the market, and then bigger pharmaceutical chains now, they are trying to fight for that. And if you understand the model of growth, first of all, you will see that it's impossible to grow faster than this type of pharmacies become available on the market. It's one thing, but secondly, you probably understand that majority of those pharmaceutical chains, they have a very high goodwill level, because when they buy this pharmacist, they fight. So it's like auction between them, and of course they're happy to pay premium price, because they know after they purchase this pharmacy, they'll lock this area practically forever, right? Nobody can move and open the pharmacy next door. So they're going to serve that environment. So of course, Like if we take United States, there are two biggest pharmacies there. It's networks. It's first of all CVS Health, and secondly that would be WBA. So they cover practically 75% of covers 75% of population in the United States. So quite huge networks in this particular case. All right. So loyalty of clients. Also margin regulations. Not in every country we have margin regulations, but in some countries there is a certain regulation. So if you produce a drug, so you cannot sell it at any price. Now in United States, I don't think they have this regulation, but in some European countries they do. And it means that if, for example, you cannot increase the price from the manufacturing price, would say double or like triple, would say all these middlemen, they cannot increase in total that amount of money. And of course, it limits the distribution of certain drugs, and it limits the profitability of some companies as well. So, like I mean, in this particular sector. Okay, and it is important for us to know, because when Walgreens purchased the company in Europe, and they expected exactly the same results as in United States, but eventually they understood that the profitability of that part of business, European part of business, is not as good as American part of the business. Okay, this is the interesting thing. Now, about loyalty of clients, the loyalty is in the case that if the client, I mean the patient, comes to the pharmacist, very often they open certain personal information and they tell pharmacists about their disease or whatever problems they have. And of course, people, they don't like go to different locations and constantly talk about their private things. So that's why if they find one pharmacist, they probably stick to that particular pharmacist, and they're going to come again and again and again to the same location. Also, there are certain type of drugs where if you go and you give your prescription to the pharmacist keeps the prescription. So, and after that, the client has to come back to the same location in order to continue to get the same drug. So, for example, if the prescription for, we'll say, 3 or 4 months, and the client gets the medication for 2 weeks, so in 2 weeks' time, they have to come to the same pharmacy in order to get the second portion of his treatment. Right, so somebody is actively typing here. Just a second. Okay, and also I was selling, it's high competition from other not pharmacy retailers. Majority of, like personally, like a few years back, I believe that pharmaceutical business won't be affected by COVID, because people will be still coming to the pharmacies to buy drugs. But yes, they will come in and doing all this COVID-related treatment and vaccination and buying medical stuff. But at the same time, like the product, like hair products, skin products, and not medical product, like the prices, not the prices, but the sale level dropped quite a lot. And even pharmacy stores were affected by this type of situation. So because it is a high competition between pharmaceutical network and normal stores, we have to take it into consideration as well, okay, because they can sell it very easily. Now, and also if you go to Value Line or other reports, you will see that recent financial results got worse. And the main reason, first of all, the cost of delivery, because of fuel cost increase, it's one thing. And so that is why Kucheri may have trouble as well. So I'm just wondering, guys, is it you typing, because it's constantly, just a second, I probably close it, Facebook here. All right, and also the high inflation, which is already happening for the last year. It's affected the cost, and majority of businesses, companies like retail companies, because the high level of competition, they're trying to increase prices very carefully in order not to scare their customers, but their cost growing up because they have to buy from suppliers at higher prices right now. So of course, I understand that they're going to move prices up in order to adjust this margin. But at the moment, what happened, at least if you notice that company like Walmart, it's collapsed nearly, right? So in prices, and other companies as well related to this industry, they also had like their results much worse than they expected, and because of that situation, so the margin was squeezed. Okay, if they don't increase their prices or do it in a kind of not as fast as the increase in costs, so we will see it in the future as well. So we have to take it into consideration when we are buying the companies. Okay, now this is the value line, so you can see that industry rank is 44. The biggest company is Walmart. It's taken more than a quarter of the whole industry. Then Costco, and we can see that Target here, and then we can see CVS and WBA, both companies which are used to be in pharmaceutical sector, now they are in a retail store sector. Okay, and we can see that compare WBA looks smaller than CVS, even though in the sales volume, it's by capitalizations here. But if you take in the sales volume, WBA actually was, I think, bigger than CVS, and it was 12th biggest company by sales level. Okay, so it's quite of the in Forbes last year. Okay, so which is pretty interesting. Now, what I've done in screening, I put only 4 parameters. One parameter is the industry. Second parameter, the earnings growth in the past and the earnings growth in the future. And I put more than 5%. And then I put P/E ratio between 5 and 15. And out of 30 companies, only 4 companies left. 2 of them, CVS Health and Walgreens, so used to be pharmaceutical services, and then Canadian Tire, and then Big Lots. When I put it in Finviz, actually this Canadian company disappeared. Probably Finviz doesn't have it in database, and only 3 companies left. We can see that all 3 of them on a downtrend. CVS Health not as much as WBA or Big, but still kind of we can see for the last few months the downtrend here. Also, it's dropped from the maximum price of 110 to 95. When it was here lower, so it's about 15%, whereas WBA from $55 to $40, so it's nearly 30% drop. That was for the same period of time. Okay, so that's why we are looking at WBA today, not CVS. And actually, if you look here, so Walgreens Boots has P/E ratio trailing 12 months 7.6, so less than 8. Whereas CVS Health, it's 12. So the company has similar type of business. There are some differences, but in general, they're very, very similar, and they're competing between each other. But we can see that at the moment, Walgreens Boots on a sale compared to CVS Health. All right, so let's have a look at the company, what they do. They have 3 segments: Retail Pharmacy USA, Retail Pharmacy International, and Pharmaceutical Wholesale. Actually, if you look like say at the history of Walgreens Boots, so it used to be Walgreens, which is American part of, and after that they bought Boots Alliance, I think company called, and now Walgreens Boots Alliance it's called. So Boots Alliance, it's represent their foreign business part, and at the moment they have their business in 25 countries, but still the biggest business is in United States. Okay, and we can see that 67% of their business contributed by pharmacists, okay, and 33% by the remaining business. Okay, pharmaceutical wholesale is also. The interesting thing here, which definitely have to take in consideration, 70% of common stock is owned by their directors, which is pretty amazing if you take into consideration that right now it's about $38 billion capitalization company. So it means that about $5 billion is owned by the directors. So pretty impressive. And also 80% of the stock is owned by institutions. Okay, at the moment. What I did, I listened their podcast, not podcast, webcast, okay, earnings webcast, and they're quite positive on what is happening within the business, and they have different strategies in order to improve their business model. And one of them is called Village MD, where they opening the location just close to medical doctors, and what the rate of opening, it's one location per 3 days. So they already opened nearly 100 location during this period of 2022, and they are planning by the end of 2022 open more than 200 locations like that. All right. Also, what they do, they communicate with different, let's say, health systems, okay, in different areas, in order for them to recommend and kind of link businesses together. So they are trying to find the ways how to improve their both businesses by integrating different companies together. And also they develop Walgreens Health consumer app, where they can answer questions for clients. And of course, after that, they probably talk about some education or lead them to Walgreens health center or pharmacy, okay, where they can get prescribed a drug or whatever drug there. So that's how they work. They have positive outlook, and we're going to look at the positive outlook. So you can see also, you see into new markets, including Boston, Massachusetts, etc. All right, so this is the way. Okay, this is the business itself. I presume everyone at least some kind of understand how these businesses operate, because we have to go to pharmacy and get some drugs. All right, so let's have a look at Walgreens value line report. So the value line report was done in April 2022, 22nd April, so it's a month old. The price was $44 at that time. Now it's $42. And let's have a look. So first of all, they have dividends, which 4.3. Before it was very attractive level of dividends. Now, taking into consideration that inflation is nearly 8%, it doesn't look that good, right? And still, it's better than nothing, but it's already not as attractive as it used to be. Now, timeliness is 3, safety is 3, and beta is 0.85. So it's quite low. But at the same time, if we see that there are so many unknown things with the market, and we expect that all these troubles, they can kind of drag the market even lower, maybe volatility is not that bad when it's low, because beta shows us if the market goes high, so volatility, company with low volatility wouldn't go as fast as the market in general. But when the market drops down, the companies with low beta, they're not going to drop down as much. So probably it gives a certain kind of reassurance, right, in this particular case. Projection, value line has a projection that company is going to be between $70 and $100 within the next 3 to 5 years. So which is from 16 to 25% annual growth, which is pretty impressive. But if we go for the short term, kind of middle term, right? So we can see that it's actually can go to $23.57. Okay, so it's quite low, 23. It's nearly half of the current price. So probably there are certain uncertainties right now, which value line takes into consideration, right? And it might happen. But if we look at the average middle point of those two kind of barriers, right? So it would be $40, which is just 5% below the current price. Okay, this is but you still have to take into account. Now let's have a look at sales level. What is happening per share, right? Company in 2006 was selling $47 per share. Now it's $150. Last year, like previous year, it was 161. We can see that during the COVID, the sales level was affected, but it wasn't affected as much. And if we look at their profitability earnings, it's actually even grew a bit. Okay, so they sold less product, a tiny bit, but the profitability grew up. Okay, so it's not bad. Consider that some businesses during that period of time, they had very bad results, especially in the retail industry. We can see that their projection for 2022 is already higher than last year, and it's actually flat for 2023. And after that, they see them earning $7 within the next 3 to 5 years. Okay, so they believe they're going to grow. Okay, in this particular case. So if we actually go to the next page and see their growth rate, so generally they have in average 8% sales and earnings within the last 10 years in average. If we go for the last 5 years, our sales was growing faster, 10%, and earnings 6%. And if we look at their projection in the future, they have 5% growth in sales projection and 7.5% projection in earnings. So the company is still growing in a growth stage, and we understand why the company cannot grow fast, because it's not up to them sometimes just to open new locations, right? So they have to find those chains or individual pharmacies which are on sale, and only after that they can buy them. It's one way. Secondly, they increase the level of sales in one particular location by integrating with other businesses and dragging clients from another competitor, which would be CVS Health. All right, so this is the way it works. Now let's have a look at the earnings. So what we can see, the company was making $1.7 in 2006, and then start to growing, and we can see it's practically every year except 2011, a slight drop here, and then it was a slight drop in 2019. Okay, so they purchased new company, I think in 2017, right? And usually every purchase, it has certain cost integration, and we can see that the earnings increase quite quickly here from $115 to $152 within this 1 year, but the sales level was kind of stuck here. So it grew 20%, but not as much as the sales level. And then it's dropped. We can see for 1 year we have this drop in 2020, but maybe it was affected by COVID exactly in this particular case. Now, company pays dividends, and we can see they constantly increase. Every year they have increase in dividends, a tiny bit, but still they have this increase. So if you focus on dividend kind of income, so this is one of the good companies for that particular. Okay, so margin, let's have a look at margin. Gross margin was 27-30% at a certain stage, but now slowly dropping down. At the moment it's 22. Okay, so it's quite huge drop from 30 to 22. Now operation margin is 5, and the net profit margin is 3. So it's very tiny profitability here. So they don't have much room for discounts and etc. Right? So they have to keep prices pretty steady, because the competition in this area is very high. Now the good thing about this company, what I've noticed, they have negative working capital. So they managed for the last few years, okay, since 2018, they managed to jungle their suppliers. So basically what they do, they get the product first, sell it, and only after that they pay their suppliers. Okay, and they don't have to have their own money put into the products. Previously, if you look here, they had to put $2 to $3 million. They have to have a current kind of ratio in order to run their business. At the moment, it seems like they're running in a negative, right? So look at this 2021, $6 billion in negative working capital, and they're planning to keep it exactly the same level. So if we go for current position, okay, balance sheet, so we can see that current assets $16 billion and current liabilities $22 billion. Right, so $6 billion difference, and majority of this account payable, which is $11 billion. So they own somebody. Okay, and the company, when the company is so big, they can't keep their suppliers kind of the payment to their suppliers as far as they can. Same story happens actually to other retailers as well. I know that Walmart can do exactly the same thing to their suppliers. Okay, now let's have a look at probably valuation from the price perspective. So we can see that at certain stage, Walgreen was 22, 26 P ratio, right? And then slowly kind of start dropping down. So to 15. And here we can see for the last few years, it was 11, 10, like close to 11, 10 and a half, 9 and a half last year. And right now, value line says 8.6, but if you go to value line now, I was doing screening today, it was 7.6, right? So less than 8, which is never happened before. I mean, like in average perspective, probably sometime during that time in the past, when the price drops down, we could assess, and yes, P ratio could be 7. But the same year it could be 14, and then in the average it will be 10 or something like that. So at the moment we have one of the lowest P in history. So we can see definitely that the company is lower than in average within the last several years. It's one thing. Secondly, it's definitely lower than their competitors. So we can see that CVS Health is around 12. And also it's lower than any other company on the market right now, because we can see that in average index is around Dow Jones 18, and P ratio for Standard & Poor's is 20. Right? So we can see definitely that this company undervalued in all aspects, with its history, with its competitors, and in the general on the market. All right, so let's have a look. So actually, that's the amount of stores. We can see at the moment it's 12,096 stores. We can see. Okay, so let's have a look. Good thing you see, never happened the loss, always in profit, which is pretty impressive. Okay, that's where we see officers and directors own 17% of the stock, Vanguard 6.7, BlackRock 5.8. So you can go to website of this company and then to read their financial report if you want to do that. Now, here probably I already told you what is happening with this company. Okay, so actually what they did, you can see that the earnings predictability is 80. So they write 8% of the 8 times out of 10. And what I did, I went to the estimate, right? And you can see that majority of time they beat their results, actual results, a bit higher than their projections. Okay, so it kind of gives you certain reassurance. And the main reason when they drop during the earnings, it's not because they kind of missed the earnings projection, but usually they do lower projection in the future. They say, look, yes, we overcome or whatever, we did better than we expected, but in the future we might not do as well as we did this year or last year. And as a result, company drops during the earnings reports. Okay. Okay, guys, usually I always ask in this stage, what do you think about the company? Is it a quality company? Is it an undervalued company? Can you put in the chat? So your opinion, if you can put the numbers, that would be even better. And I'll have a look what you have. And after that, I'll show you what kind of results I got. Very undervalued. Okay, the rest of you guys, Alex, Jeremy, Jean, Max. Okay, no, 3x4, 4x4. All right. Okay, Alex, Jeremy, any opinion? All right. Okay, let's go have a look. From quality perspective, this company not as good as we would like it to be. and the main reason they don't have within the last couple of years the growth in earnings. Like, I mean, they had a drop, and remember when we evaluating it, the company has a drop in their earnings slide, so it's already reducing certain points for this company. So that's exactly what happened here. First of all, the sales growth is faster than earnings growth. It's certain disadvantage. So the trend is missing there, right? So it's not constant growth. Sometimes we have drops in earnings in this particular company. So it's also a negative factor which affected these numbers. So basically, industry, we can see 1 point is missing. Timeliness, 3 points missing. Safety, 3 points missing. Debt, quite high level of debt. It has $13 billion in debt. Let's have a look at this. Now we can see that $13 billion in debt and $38 billion in capitalization. Now it looks like pretty huge compared to its capitalization, but what we have to take into account is the possibility of paying that debt. Net profit of this company for during last year, it was $4.2 billion. That's his net profit. So if they decide to pay the debt off, so they actually be able to pay it within 3.5 years completely, right? Taking into account the cash flow, it's actually higher than earnings, so nearly 40 to 50% in some years. So it means that they get $4.2 billion in profit, net profit, but actually cash, which inflow in the company, it's higher than that, so nearly 40%. So it would be about $5.5 billion. So in this case, it's only 2.5 years. If they decide to pay that completely, I don't think they're going to do that because their return on equity is 17%, right? And if they pay probably interest of 3% or maybe 5%, like as a business loan, so what's the point, right? So it's much better to allocate the capital within the business and make more money, okay, rather than save on the debt payment. Okay, then, but we see here we lost 4 points on that. Then beta, as I said already, we have low beta, so it's again based on this express analysis, we lost 3 points, but in reality, maybe the low beta at this particular unknown time, okay, it's not that bad. Growth trend, we can see it's lower because this company is not fast growing company. Sometimes when we invest, we have to think, yes, we might, if the market is great, everything is rosy in the market and people spending money like hell and they're not worried about what is coming in the future. In this particular case, we might put money in fast growing companies, right? And in this particular case, all this growth trend would look fantastic there. But when the time is tough, fast growing companies, they might become fast dropping companies. And Max probably following Katie Wood, and you probably can tell how low her portfolio right now. For the last few years, she was nearly god of the stock market because her portfolio was just increasing like crazy, and everyone think, oh my goodness, she's the new Warren Buffett of the market. But now her portfolio nearly collapsed because the majority of her money was in high growing stocks, which lost quite a lot of value. Some of your companies nearly 70%, 80% in values. I understand. I don't know, Max, maybe you can approve or otherwise what I disagree with what I'm saying. Now, so we have 32 points. So it's still quality company, not quality, high range, let's say company, strong company, but not ideal quality. But from valuation point of view, it's undervalued in all scale, right? It doesn't have the maximum point, but still it's undervalued. It's lost a bit on the sales versus earnings because sales are growing faster than earnings, but in other aspects, it's the best in this particular case. And we already said that it's undervalued compared like to itself historically, then undervalued compared to its industry competitors and in index as well. So now, tangible book value, it's negative. It's minus $8. So you probably understand if the company is going to liquidation, you won't see penny there. So it's going to be completely sold off, and then they won't be able to pay the debt to the banks. But it doesn't look like it's going to get into liquidation. Now the earnings is going to be only 30th of June, so we have some time to trade this company if you don't want to trade over earnings. Okay, so like that. And let's have a look at the projections. So if you calculate all the highest prices, you come to the average high, which is $73, and then you calculate the highest, the lowest prices during the year. You come up to the low points, average $49, and then you look at the earnings during those years, and you come up to average earnings. So, and based on that, you can calculate the average P ratio highest when you divide higher average by average earnings. So, and you come up to the P ratio 13.6, right? So, and if you do the lower price, divide by that, you come up to the P ratio of 9. So what it means that in generally, when everything is good, fantastic, people pay 13 times of the earnings. And when everything is not that rosy, people pay in average 9 times of their earnings. So if we look at the projection which Value Line gives us, and company, of course, because Value Line based their projection on company projections. So, and if we see that the company is going to make $7 within the next 3 to 5 years, so we can expect that if the company does that, so people are willing to pay the highest price for that. So we'll multiply 13.6 by 7 and we come up to number 95. So the price can go to $95. But if the people are not seeing what they expect to see, and they're willing to pay only 9 times of their earnings, and we take that the company is not growing but it's stuck on the same level as last year, so and it would be $4.90, it means that the company price has to be around $45, $44.99, right? So current price is below that, so we're already out of that range. But if we take into consideration just this calculation, and then we kind of assume that about 30% of the time is going to be somewhere in the higher range, then 30% somewhere lower, and 30% in the middle. So we can come up to these ranges. So buy range up to $61, hold range up to $78, and sell range after that already. Okay, higher than that. So at the moment we're below the lowest stock price, projection range. Okay, so this is. Yeah, and it is not even the bottom for, okay, Max roll. Okay, so this I already shown. Okay, guys, about fundamental analysis, all clear? If all clear, we'll go to technicals, okay? Now, this is how it looks like. Actually, I could go much earlier. Walgreens exists for very long time, okay? And I think the price, it's of course it was adjusted with splits, but if you go initially, it was below $1, I think 70 cents. Can you imagine you could buy it at a certain time at 70 cents, and now your only dividend is $1.7 annually, right? So which is fantastic. You can see it's not great story from the growth perspective. It's not stable growth. Sometimes it goes up, sometimes it goes down, sometimes it's for decade it's in a flat area. Sometimes we can see a very nice growth, and that was the maximum, I think 102 or something like that, the price, and now we can see it's dropped down again. Now if you go back to Value Line and look at 2016, at this 2016 where they was the highest price, actually the earnings was about 10% less than it is now. So what it tells us that at that time the company was making less money than we make now, but it was twice as expensive than it is now, okay, the pricing. So it means that it just changed the perception of people on the growth perspective. So here the company purchased in 2012 one of the Alliance Boots businesses, and people expected the high growth at that stage, so they overpaid for that, right? And we can see that nowadays vice versa. So people are not seeing the companies growing fast, and they're paying very little compared to the market, right? So that's what we see. So this is the highest price. And that's how it looks within the last few years. Actually, if you notice, it has a pretty stable support at the level of $45, $46, at least it had here. And at 55 at a resistance. Actually, probably if you draw it, I'm not sure if I can draw it here. Just a second, if I can draw it. Okay, so if we probably draw the trend something like that, in a parallel trend like that, so it's slightly downtrend, right? And we are somewhere, if I write it more precisely, we are somewhere at support here. So on this trend, right? Maybe this part is a bit lower, right? And this is trend as well. So we bounce from it. So it was a good candle, a couple dodges. How do you stop it now? So if we look at here, it was a couple dodges, and after that moved up. But probably tonight we are going to see it's dropped. If the market is going down again, so we might see it again dropping down. So it's still downtrend, as you can see, but we have couple levels here. So one is here support, and another is support here. So if you decide to trade, probably it's good to use a stop loss here. If you just buy shares, if you use options, probably there is a different way to hedge your portfolio, but still, you have to think that the trend might continue even low. All right, and of course, there is a question here. So where do you think, if you decide, okay, guys, again, so if you like the company and if you decide that you might do something with this, so where do you think your entry point and exit point will be? All right. Again, remember that you don't have to be right. You just have to just put your thoughts here. So we're discussing, and after that, I'll tell you my way of thinking in this particular case with this company, and then we'll compare them. All right. Can you write it down? So what do you think? Where will you buy? It doesn't really matter if you trade options or stocks or doing. You still need to know where your entry point and exit point based on stock price. Okay, and after that already. Okay, Max 39 and 43.50. So 43.50 is somewhere here, and 39 is somewhere here. Okay. Anyone else? Okay, everyone is quiet and shy. All right. Would not buy anything until September, October. Alex. All right. Okay. What's happening in September, October? Markets start growing. Maybe you know something what we don't know. All right. Okay. So just a second. Okay, guys. Again, remember that we always buy based on your portfolio sizing, right? So you need to know how to size your portfolio and how to allocate certain amount of money to any particular company. It's one thing. Secondly, you have to understand your strategy fully. So based on your personal preferences, your like duration of your trading activities, are you going to hold for long term or short term? So you need to know it before you place any trade, okay? Because you are responsible for your own income and for your own losses as well. So you have to be aware of that. Now, what I would do based on what I have now, if I buy it, for example, for long term, 40 to 42. If I see it keep going down, I will probably look at this. But if I buy at 40, 42, I might hold it at 78, 95. It might take 2 to 3 years, maybe longer, but it gives me up to 100% profitability on the capital growth, and also I will receive dividends, like nearly 5% dividend on the current investment. Now, if I decide to trade, which like in the middle term or short term, so you can see that the rolls here are not that big. Okay, so from, let's say, 40 bucks, let's say here it was 42.80, 42.30, and here's probably 44, maybe 40, 44.80. So it's around 5%, 5%, 8% like roll. So it's not that huge, but still, it's only a week, right? So a week and 5% you can make it. So if you manage to buy it, so it's kind of, you can do money up to 8% profit on each roll. Double L has to be here, and maybe it's one of your strategies, but definitely use stop loss here. If you're doing roll strategy, you're not willing to hold the position for long period of time, so definitely use a stop loss. And then option strategies. Let's have a look what we can do here. So if we decide to sell put, okay, so what happens? The last price was $41.80, and let's have a look. So if we take at the money roughly, so it's 30 cents, 36 cents. Maybe you can get around 40 cents bargain. So around 1%, a bit less than 1%, but that would be less than a week. Okay, but that's what you can get. If you go for 2 weeks, on June the 3rd, for the same strike, you can get 65 cents. So it's 1.5% for 1.5 weeks, a bit more than 1.5 weeks, but you can get 1.5%, which is not bad. I mean, so you can get close to 4% monthly. Now, and then it took a month. If you go directly for a month, there is no 41.50 strike, so it's 41, and this last price is incorrect here because it's kind of strange, because 42 put is less in price than 41 put, so definitely mistake. So I probably will look somewhere here. Maybe it would be 1 point, I don't know, 10 or $1 even. The spread is huge here actually. I don't like the amount of spread here, and so it gives us about 2.5% for 1 month, so which is not that fantastic. So if I try to sell personally, I would probably sell for a short period of time, maybe for a week or for a couple of weeks max. Okay, so that would be my selling point. So a similar story if you sell a call. So if you already have the shares, so if you bought the shares at 41.84 and then took $42 strike price, you can get 97 cents, which is more than 2%, which is not bad, right? So in this particular case, so it's actually a bit bigger, more than on puts. Interesting enough, right? So. Okay, and if you look leap calls, if we decide to go with buying calls, and there is no 41.50 strike, so if we go for $40 strike, that would be until January 2023. So it's about 7 months. Okay, market can fall further. Of course, Alexei, it can fall further. So that's why we need to understand every strategy we do. But if you sell puts, at less dangerous than buying stocks, if you take this into account. So if you buy call with a $40 strike price, you would pay $5.35, $5.30, and $1.8 it would be intrinsic value, so you have to deduct it. So 5.3 minus 1.8, that would be what? 4.3, $3.5, right? So $3.5 is the time value, which is what, about 8.5% out of $40. If we go for $40 in 2024, so it means that we're going to pay $7 minus 1.8, it will be what, 5.2, which is 13% for 1 year in 7 months. Okay, guys, what do you think? Which strategy is more applicable in this particular situation? Is it buy and sell shares, sell puts, or buy calls? What do you think is preferable here? Are puts expensive here? Like, I mean, when calls, long calls, are they expensive or not? Okay. All right. So basically, the way you do with puts, we calculated profitability, right? So which is we can receive. With calls, you calculate the profitability in a way that if you go and buy a $40 put, you pay $7 here. Or let's do this one. You pay $5.30, and then say you go and expect that within next, say, 6 months, it goes to around $48, right? So somewhere here. So it means you can buy at 40 and sell at 48. So at least, even if you do it in the last moment, you're going to get $8. Okay, so which is 30% higher than the purchase call. Covered calls, yes, covered calls would be even better than selling puts. If you buy shares and sell covered calls, you instantly reduce the drop, possible drop, and you also get dividends. That would be an advantage as well. So something like that. So with the buying calls, you limit your risk. So if the share keeps going down, you still have $5 on the loss locked there, and if it goes up, so you have higher rate of return in this particular case. The only worst case scenario, if the company is stuck on the same level, and within the next 7 months, it never moves, eventually time value just disappears, so you will lose this amount of money. In this case, you might move and do diagonal spreads, so calendar spreads, where you can sell calls on a leap call. Okay, in this particular case, you can get pretty good profit. Okay. All right, this is the guys what I have here. So if you have any questions, please ask. If you want me have a look at the other companies, we can do that as well. So if you ask, we can look technically, we can look fundamentally, if you're interested. Okay, SWKS. I'm going to stop share here. Okay, and sharing. Okay. Guys, can you see the chat? Okay. All right. Okay, great. So let's have a look at SWQS. If I remember, it's still kind of downtrend. Yeah. So that's what we see. It's actually even speeded up. So if we see that trend, and then we'll try to, because this is where. So it's kind of started speeding up down even more. All right, earnings were worse than expected, but tiny bit. Look at the surprise level. Okay, and let's have a look at can you see guys Guru Focus as well? Yeah. You can see the sales revenue per share growing constantly, right? 17, 19, 21, 19, 19, 30. So very 50% increase in sales. Trading 12 months also better. If you look at diluted earnings per share, $1, $1.40, $2.30, $4, $5, $5.40. A bit slight drop here, another drop here, another drop here, doubled earnings in 2021. Okay, and a slight drop right now. Now the thing is here what might happen, because during last year a lot of companies in this sector, they had a better than expected jump in sales, and after that they might have the same type of business which they had previously. In majority of cases, if they didn't increase infrastructure and or sales capability in general, because last year it was everyone was just buying and improving the IT infrastructure. Okay, so and that might be a temporary jump in sales and earnings, which might come back to the same level which was before if company didn't do anything to keep it on the same level. We don't know. I have to read reports, but assuming if the company goes back to $5 or like earnings somewhere here, so it means that current P ratio is about 20. Now let's have a look what they generally had, valuation ratios. So P ratio 21, 15, 19, 18, 16, 30, 20, 18, now it's 12. So based on the last year earnings, trailing earnings, right? So it's 12. But if the earnings drop to $5 level, so we're going to have 20, which is at the higher range. So that's why probably SWKS keep dropping even more. Maybe people believe that it's not going to have that amount of earnings. Maybe they already made projections like that. So what I do recommend, Max, definitely just look at their projections from the company, listen to their webcast, and they will probably tell you that. This is, and also in the beginning of our masterclass, we talked about tension around Taiwan. I'm not sure how business of Skyworks solution related to Taiwan manufacturing facilities, but I presume the whole IT sector would be affected if something happens there. Okay, so it gives certain unpredictability. Okay, Doris stock today called Unit. Okay, let's have a look. Okay. Very interesting roles, right? Okay, one role, two role, right? So pretty impressive, nearly 30% roles. Okay, let's have a look what the company is doing. Okay, revenue per share, $5, $5, $5, $5, $5, $4, $3, $3.8. So it was stable before, and now it's even for the last 2 years, 3 years, it's kind of slightly going down in revenue. Then let's have a look at earnings. Negative, negative, positive 4 cents, positive, negative $3, positive, positive. I don't know this company, Doria, so I'm not sure what they do, but based on what I see, they don't have a growth in sales, even drop in sales, and their earnings all over the place. And even when they're positive, they're tiny, but when they're negative, they could be like, it's huge drop, $3. Can you imagine they have $5 in sales and $3.4 in the loss per earnings? So it's quite a big one. So what do they do? Unit Group is a real estate investment trust focused on the acquisition and construction of mission critical communication infrastructure, including but not limited to fiber, wireless towers, and ground leases. Interesting. So rate business, like the valuation is going up quite a lot. Not sure why they are not making money. Maybe they are buying royalty. Here, at least you can see Guru Focus cost 66 out of 100. Actually, they start doing it nowadays. Very interesting. By the way, remember we looked at Google. Do you want to see the Google? $100 of 100. So the best. Okay, so this is the best. So if you buy Google, right? Okay, so that's why, Dory, I wouldn't probably jump into unit personally. Okay, guys, anything else? This is Walmart, dropped from 160. %25 drop for the last month, right? Which is a very big retailer. It's going to stay there forever. So it stops on this level. Pretty interesting, but valuation still P ratio is 25, very high. But it's always high. Walmart is always high. VMW, did you see, guys, the jump last night? Like, I mean, last trading session. For us, it was last night. Earnings. It seems like earnings today. I don't know why it jumped. Maybe it was last night. I just didn't read. I just saw that because I have it in my portfolio, and I enjoy when it's jump 21. Okay. Broadcom is trying to buy. Okay, VMW. At what price? Did you tell, Max, at what price? Not yet. Okay, so yeah, it's kind of, it's growing a bit more, so it would be nice for me. Qualcomm as well, kind of in a nice, very interesting place. That was a resistance, 122, support, bounce. So a few times we bounced from this level, about 120. Indicators are already in over sold situation, but not turning yet. So, but definitely I'm keeping an eye on it, on this particular company as well. So there are quite a few companies which are very interesting right now, but because of all these announced things which happening right now in the political arena, I'm kind of watching them closely, and if I buy, I'm probably going to use stop losses with those companies. All right, maybe SHYF. SHYF. So the shift group. Let's have a look. Wow, so huge drop. %63 drop since the beginning of the year. Right. Let's have a look what to do. Shift. Correct. Yeah. Go focus core is very nice. Industry, farm, and heavy construction machinery. Sparta Motor has a market engineer manufacturing the heavy-duty custom vehicles. It operates in 3 segments: emergency response vehicles, delivery and service vehicle, and specialty chassis vehicle. Okay, let's have a look. The sales growing very nicely. Market cap interesting. Look at the market cap. It jumped from 1 billion to 1.7 billion, and for whatever reason, it's now 7. No, yeah, market cap has dropped because the price dropped. P ratio used to be 25, 30. At the moment, it's 14. Earnings per share was negative in 2019. I would definitely check it here, what's happening. Actually, the earnings are very, very tiny, like generally tiny. And just now they started making money. Okay. And 91, $1, and this is a drop. They pay in dividends. Okay, and the P ratio. P ratio is low, but let's have a look at the competitor. I think it's D, if I can remember correctly. Yes. D just, let's see. Pre-COVID level as others. Yeah, the bubble is going away. So D, it's also they're doing heavy machinery, and they have also huge drop from 440 to 300. So %, not 60% as a shift, but also quite a lot. But if we look at the way they perform, they're still growing here, and the earnings are still growing up here. They were flat for quite a long period of time, and for the last couple of years they're growing. So P ratio would be 26-14. So compared to, would say Deere, Shift definitely undervalued. But I would read more about this company, because based on their earnings, they just started making money for the last couple of years, like last few years. So have a look at them, Dory. You might know more about them if you listen to the report. Okay, anything else, guys? All right. Guys, because I came just last night, very late, around 2 o'clock in the morning, I came from Blue Mountains. I didn't have a chance to look at the schedule for the next few weeks. Usually we have some kind of meetings in a place. So probably what I'll do, I'll check the timetable and post it in our group, okay? So one of the next Tuesdays. Okay, doc. All right, so if you don't have any questions, I wish you a good profit, make money, enjoy the process, okay, and don't be scared of the market drop. It happens all the time. Okay, remember, we will survive. Okay. All right, guys, all the best.